As a result of the COVID-19 pandemic that played havoc with world trade and economies, inflation is once again rearing its head above the parapet as concerns of rising inflation are becoming noisier. But what are the effects of higher than normal inflation on your business? And most importantly, what can you do to protect your SME business from the possibility of higher than normal inflation? In this part 2 of this series, we will cover the relationship between your business and inflation, the relationship between taxation and inflation, and finally 4 actionable ways that you can protect your business against inflation. And if you have not already done so, it is advisable to watch part 1 of this series first by clicking here so you can get foundational knowledge and context for this episode. Before I get into today's video, be sure to visit our Accounting and Tax Academy membership area where you can get access to exclusive in-depth courses, templates, calculators, and a members-only Q&A section where you can get your specific accounting and tax questions answered by a qualified accountant or chartered tax advisor. In your small or medium-sized business, there are essentially 3 sides of your balance sheet. That is assets, liabilities, and equity. There is also the income statement or profit and loss account too, which is a primary statement, but inflation has more of an effect on your balance sheet items, which is where I'm going to focus. Now, the most common types of assets your SME business probably holds are cash money in the business bank account, plant and equipment such as laptops, hardware, machinery, and other equipment, stocks for goods for resale, and debtors, essentially people or other businesses, entities who owe your business money. Now, I accept there are more types of assets such as fixed assets like property or investments, but for the purposes of keeping this episode as simple as possible, I'm only going to focus on the most common types of assets in my experience at large. And then the other side of your balance sheet is the liabilities. That's creditors, essentially people or entities your business owes money to, including the taxman for PAYE taxes, VAT and corporation tax for a limited company, income taxes for sole traders, and loans or short-term borrowings. Now, for your assets, if you hold these for a prolonged period of time, then inflation at higher than normal rates can have the effect of eroding the value of these assets. Remember from part 1, the purchasing power. Higher than normal inflation rates can perhaps be defined as inflation above the Bank of England's target rate, which is 2% for the Consumer Prices Index, CPI. The Bank of England also makes a very good case for soft inflation, that is the 2% target, as the opposite of inflation, which is deflation, has its consequences too. However, you, the business owner, needs to determine your own materiality. What rate of inflation starts to become an issue that makes you think about taking action to protect your assets against this inflation. So, for example, if your business is micro-small, has, say, only £10,000 of cash on your balance sheet, and inflation is running at 2% per annum, then perhaps the maths does not worry you too much, and a £200 erosion of purchasing power over a year of the cash in bank is not too concerning and quite absorbable. On the other hand, if your business has £100,000 of cash on its balance sheet and inflation is hitting 5% per annum, then perhaps a £5,000 per annum erosion in the purchasing power of your cash assets is material and worth your attention to take action to protect against. The flip side to assets is, of course, liabilities, and this is where perversely inflation can actually work in your business's favour. How, you may be asking? Well, let me show you with a simplified example. Let's say your business took a loan of £100,000 at a fixed rate of interest of 4%. That's £5,000 of interest payments per annum. Let's suppose inflation went up to 5%, and as a result, you raised your prices and did everything you could to protect your business against inflation. As a result, the true value of the £100,000 liability starts to erode in your business's favour. And what's more, the nominal rate of inflation in this example, that is the 5% exceeds the nominal rate of interest your business is paying, that's the 4%. So in real terms, the debt is eroding by 1% per annum. Or another way to look at it is that your business is benefiting from a minus 1% real interest rate. Not great for your lender, but perfectly fine for your business. Now, a small caveat here for you economists and analysts out there. I accept there are more variables and factors at play, but my objective in this episode is to simplify explanations as far as possible without compromising the true facts and principles. So how does inflation interact with taxation? Well, from an economic point of view, a rise in taxes by the government should have a dampening effect on inflation, as your business and the population at large should, in theory at least, have less money to spend due to the tax rises, and less money circulated and transacted, in theory, leads to a slowdown or reduction in the rate of inflation. However, if the government then goes and takes this additional tax revenue and spends it on public spending, for example, well, then all they've done is really channel the money into something of their choosing rather than yours. So with regards to your business, the main taxes you will be liable to are PAYE income tax, VAT, corporation tax, and income tax. For VAT, this is linked to general prices of standard rated goods and services. So inflation will cause a VAT element of the price to actually rise too. PAYE, that is pay as you earn income tax linked to your employees or even your own director salary payments. Quite often, if inflation starts ramping up, you will get demands from your employees for a salary increase as their household fuel and other expenses increase due to inflation. And if this is the case, the amount of PAYE tax in absolute terms goes up too. So here are 4 suggestions you can action to help you manage the effects of higher than normal inflation or levels above your own determined materiality. So number 1, and this is the main one, and that is to place excess cash into either an interest-bearing business bank account or exchange it for assets that will provide a return. Now, you should only keep as a benchmark 3 months of working capital requirements to meet your average monthly expenses. And you should be able to work out your average working capital requirements from your numbers and financial statements. If you're not sure, then certainly speak to your accountant or speak to an accountant. So let's say your business has total expenses of £10,000 per month on average, and if you're holding anything more than £30,000 in liquid non-interest bearing cash in your business bank account, then it is potentially too much. This will, of course, vary from business to business, dependent upon the type and nature of your business, and quite importantly, how long it takes your debtors to pay you and you to pay your creditors. Furthermore, you're probably thinking, but exchanging any excess cash for assets that will provide a return carries a risk. And generally, yes, it will. You'd seldom get an absolute risk-free return. So for example, if you exchange your excess cash for cryptocurrency in your business, well, we all know that's a high-risk asset at present, very volatile. But if you get it right, with some luck too, it could provide exceptional returns that more than protects your excess cash from the erosion in value caused by inflation. So you should assess your own risk appetite too. And remember, the objective here is to protect the excess cash against inflation. And at the current CPI rate, which is on screen, you'll only need a return that exceeds this. Number 2 is to make sure you have an effective system to get paid from your debtors. That is, people or entities that owe your business money for goods and services provided. Often see credit terms drift and debtor balances become stubborn due to the lack of the business owner having a robust system to chase up and collect money owed. And as a result, if inflation starts to kick in at higher rates, well, this is not particularly ideal for your business. Number 3 is to do the reverse for creditors and the taxman. Now, I am not suggesting in any way, shape or form you don't pay your creditors or the taxman. What I am suggesting is to pay as close to or pretty much at the deadline. For example, you have 9 months to pay your corporation tax bill as a limited company business. So take the full 9 months to pay HMRC should your business allow this. Remember, money has a time value, and the longer you can delay payment, the more opportunity your business has to make those funds work in your business's favour. And finally, raise your prices annually. Now, this is a big one, and I often encounter so many business owners who are crippled with fear as soon as raise your prices is even mentioned. I accept that inflation alone should not be the reason to raise your prices, and other factors such as your competitors, market demand, and so on should be considered. But these other factors should be used in how much you should raise your prices, as opposed to actually raising your prices on at least an annual basis. Even a 1% raise in prices can go some way, if not all the way, and more, to hedging your business against inflation and helping your bottom line. This is Tony D'Angelo for the Accounting and Tax Academy. Thanks for tuning in.